What is up, YouTube? Mikel Hayden here, back again, and we're going to be following up with our options trading in this video. I hope you guys are ready to see what happened last time and see how we continue on this journey and using the options wheel strategy. So let's get into it. So if you can remember, we were looking at this diagram here that I made up to see how this strategy works. We started here with our 100 shares of Sofi. And moving in, we set up a call. And moving in to the wheel, we sold a call option, or at least executed an order to sell a call option above our average cost basis for our 100 shares of Sofi. And we waited to see what happened. Now, what ended up happening was our option. What ended up happening a couple days after we put in that order was the order expired. Nobody actually bought it, and therefore nothing actually happened with that option. So coming here, updating this, our profit actually ended up being 0. Nothing happened with that order. And we'll just say that our order expired. So nothing ended up happening there. That could be because volume wasn't high enough, demand wasn't there when we put in the order, or just the different variables of the order, such as the strike price or the expiration date of that order just didn't end up being what people wanted, therefore the order expired. So moving forward, looking at our wheel, we're going to start here again at the starting point of having 100 shares. This time we're going to be looking at Rivian, see if we have any luck there. So let's go ahead and jump into our Fidelity account and set up that order to sell a call option for Rivian. So let's pull up this, pull up our position so we know what our average cost basis is. It's going to be $23.47 for Rivian. And let's set up this options trade for Rivian. Pull it up. It's currently a lot lower than our 23.47. So we may have to work with our numbers a little bit to make something profitable. Let's just put this 2 weeks out to start. And then we're going to want to make sure that this is above 23.47 or at. So we'll put it right at 23.50 and see what that gets us. So we're looking right at $2 pretty much, which really isn't worth it for us. And volume's very low. Moving this up is only going to make that smaller. So we might want to just move this out a little further, see what that looks like. $4, move this back down to 23.50, and we're looking at $5 there. It's a little risky to move this anywhere lower than your strike price or your average cost basis, I mean, just because if you end up selling out, then you'll end up losing all that money. But in this case, if we look at 2 weeks out, $4, looks like February 2nd at $23 might be our best bet. Let's go ahead and put this at the midpoint and preview that order. Now reviewing this order, that is a $6.65 premium with 35-cent fee on top, which isn't a ton. And if we do end up selling out of all of our stock, we would lose money since this is below our strike price. We really shouldn't do that. But since the stock is quite a bit lower than our average cost basis, then the risk is a little bit less than it normally would be. Let's go ahead and cancel this though. We might end up doing sell to open, do one call. Let's see what happens if we put our expiration date deal quite a bit out further. Let's look at February 9th at our 2350 number. Sorry guys, the camera cut out there for a little bit. So just a recap of what we ended up doing was the following order that we put in. So we did an expiration date of February 9th. We had to go a little bit further out to get that premium up because we didn't want to bring our strike price anywhere lower than our average cost basis. If we were to do that and the price of the stock were to go above our strike price, we would sell out of our stock at a lower cost than what we bought it for. Therefore, we would lose money there. And we want to play this as safe as we can. So we wanted to keep our strike price right above, as close as we could get. And therefore, we put our expiration date quite a bit out. So here's the final order. The premium came out to $10 with an exit cost of 50 cents. So if we get to that February 9th date and the price of the stock hasn't gone above $23.50, our strike price here, then we'll collect that $9.50 profit, which isn't a ton, but as we're learning here and using a stock that isn't worth as much, it's a good learning experience. And so just to recap, we're starting here again where we did last time. We have 100 shares of Rivian, and we are putting an order in to sell a call option at or above our strike price or above our average cost basis. Therefore, if the stocks go up above that strike price, then we'll sell our stocks for profit and we can move on to this side. But if the stocks go down, they won't execute their right to purchase all of our stocks, because then whoever purchased this call option would lose their money. And so we'll collect their premium that they paid for the option, and we can do the same thing all over again. Anyways, guys, I hope you enjoyed this video, and I hope you're enjoying following along as I'm kind of learning more about options trading and the most effective way to do them, as well as following this wheel strategy. If you guys have any questions or advice, please put those down in the comments. If you like this video, give it a thumbs up. And if you're new here, please subscribe, as it helps out the channel and lets me know that you guys are enjoying this content. But anyways, thank you guys for watching, and I'll see you next time. Thanks. Bye.